I think gold will keep going up because the Federal Reserve keeps making bad policy decisions. As you may know, the Fed is now stuck in a trap it made itself and can't get out of it. In the end, this will lead to a crisis in the dollar and a crisis in national debt. People who think they don't need to pay attention to gold's rise because the bond market and the dollar aren't falling against other fiat currencies are wrong. If you want to protect yourself, you should wait for a dollar crisis instead of a bond crisis. It's too late to do anything at that point. You still have the chance to protect yourself right now. You can still get gold and silver. Gold's rise isn't a coincidence, it's a clear sign of financial loss. The Federal Reserve is stuck because of the careless policies it has put in place. It keeps cutting rates in a hopeless attempt to keep an economy that is already weak going. Every move makes the hole bigger. Gold, on the other hand, is doing exactly what it should be doing, showing that fiat money is losing its value and sending a message that the next big financial crisis will not be a banking crisis but a currency and national debt crisis. The bond and dollar markets don't really seem stable, but they look like they do. The revaluation will be more violent in the end if this keeps going on for a long time. Peter Schiff, an experienced economist and the founder of Euro-Pacific Asset Management, has been warning about this exact result for a long time. The so-called soft landing by the Fed is just the calm before the storm. The rise in gold prices above $4,000 is not a market move. The world market has already priced in the Fed's failure. The smart money is already getting ready for what's next, but most analysts are ignoring these signs. The time to act is running out quickly as the dollar's value drops and inflation stealthily lowers the value of money. Now, here are some clips from the talk with Peter Schiff. Before we go any further, please subscribe to our channel and click the icon to get information right away. Thanks. In the space. No, the subject was never even brought up. And I talked about Alan Greenspan on my show. Some people call him the maestro, and he's still highly regarded even by some people in the Trump administration who talk about him. He made it clear that gold was his way of telling if he was setting interest rates correctly. He said that even though we weren't officially on a gold standard, we were because Alan Greenspan used the price of gold to tell the market if rates were too high or too low. At $400 gold he thought he was too loose, and at $300 gold he thought he was too tight, so he was aiming for about $350. So, if the price of gold stayed around $350, that would tell him that the interest rates were about right. What does $4,000 gold mean now? If $400 gold meant that Greenspan was too loose, what does that say about Powell's plan? It's clear that if $400 was too much money in the 1980s, then $4,000 must be the same thing. That's why it should have been brought up. Oh, and I called my last show Gold Tests $4,000 Support. And some people might think, well, it failed the test since we're now below 4,000, which is true. It did happen that we fell below it this week. In fact, gold closed today below $400. It traded above 4,030 this morning, but it's currently closing below that level. We're still just below 3,950, but we're up about 20. Regarding my last show, I talked about 4,000 support and said it was likely that gold would fall below that level. I also said that 4,000 could still be support even if the market did fall below it, since I think it will be similar to how we dealt with 3,000 support. We weren't stuck at 3,000, that's for sure. The same thing happens with 4,000, we fall below it, but when you do, you are in a support zone. Just like the market never went too low below 3,000, I don't think it will go too low below 4,000 either. I also don't think it will stay below 4,000 for a long time because then too many people would be able to buy it below 4,000. That's not likely to happen though. Even though the price is now 3,950, I still believe that 4,000 is a support level. We're almost at 4,000, so this is where the support is. As you can see, the resistance is now closer to 4,500 since we did reach, I think, 4,400. We reached about 4,380, we didn't quite trade at 4,400, and then there was a move back down. But even with the drop, the price of gold is still a lot higher than it was when the Fed cut rates the last time, and it's not a mistake that rates are going down at the same time that gold prices are going up. Gold is responding to a Federal Reserve that shouldn't be lowering rates. The Fed is lowering rates because they are too low. That's why the rate cuts are wrong, and gold makes that clear. But none of the reporters who have been asked to question Powell know enough about money or economics to even ask the question, let alone point out that gold is sending a message. People who work as economics reporters for many newspapers and TV networks have to fail an economics test before they can work as reporters. This means they don't understand the warnings. After that, they can ask Jerome Powell these things. Anyway, this is more BS from the Fed today. Gold is likely to keep going up because the Federal Reserve has been making policy mistakes over and over again. The Fed is now stuck in a trap it made for itself and can't get out of it. In the end, this will lead to a crisis in the dollar and a crisis in national debt. It's not realistic to think that you can ignore gold's rise because the bond market isn't falling or the dollar isn't collapsing against other fiat currencies. Things like this will happen. People are losing faith in all paper currencies, not just the dollar. That being said, the dollar is going to lose a lot of ground against other foreign currencies soon. But of course, you've already missed the chance to protect yourself if you wait for a dollar crisis or a bond crisis. It's too late to do anything at that point. You still have the chance to protect yourself right now. You can still get gold and silver. The Federal Reserve keeps cutting short-term rates even though long-term prices are going up and inflation is still high. The Federal Reserve knows that Americans are upset about high prices, but it won't admit that it played a part in making them happen. More inflation or raising pay to catch up are not the answer. It makes money worth what it's worth again. But Powell's insistence on keeping an inflation goal of 2% forever means that prices will never go down. They are only going to rise more slowly. This strategy makes sure that people's ability to buy things will always go down, which will make savers and workers poorer over time. Printing money or creating fake demand won't bring about proper security. People save money, make things, and keep interest rates low. The Fed's rate cuts make things worse. They make people spend more, make debt worse, and give more credit without really growing the economy. This creates the false impression of wealth based on borrowing money and putting off pain. This pattern, which has been going on for decades, is what causes the coming currency and debt problems. The longer the Fed acts like it controls inflation by manipulating it instead of letting it rise, the more damage it does to the economy it says it is protecting. We need to go back to the meeting. That's why I think rates will be higher when the Fed meets again in December than they were when they cut them in November. Short-term rates are going down, but long-term rates are not participating. They're going up. But I think the most important thing about today's news was that Jerome Powell said this more than once and went out of his way to say it. Why do people still have a problem with inflation? People are still mad even though you say inflation has gone down a lot. Powell agrees with them, saying that they have every right to be angry. He told them they're mad because prices haven't gone down even though inflation has. He also said that items cost a lot more now than they did a few years ago. That's why people are so mad that prices haven't gone down. They are still going up. Okay, putting prices up makes things worse if they were already too high. It doesn't matter how little the increase is. I now agree with what Powell said. Yes, the price went up a lot and never went back down. But that's not their fault. Okay, then why are you aiming for 2% inflation? Why doesn't Powell or someone ask Powell this? Since you agree that prices went up a lot and never went back down, why not aim for prices to go down? Okay, why can't the Federal Reserve take steps to lower prices again? The public wants that to happen. Why do they not understand? Because you know that, according to the Fed, inflation was too low for a few years when it was below 2%. Oh no, the Fed said we need to average this up. Okay, it's been too low for inflation, we've been less than 2%. We need to bring it down to 2% on average, because we need to make up for the years when inflation was less than 2%. We need to keep monetary policy pretty loose. So, if you agree that people are mad that prices are so high and inflation has been well above 2% for so long, then why is the Federal Reserve not aiming for inflation to be well below 2% to bring all that high inflation back down and help the American consumer, whom he says he cares so much about? Okay. Oh, we're here to help people keep their prices stable. Okay, that means prices need to go down. There's no need for prices to rise by 2% every year. The prices need to go down. They need to go down by a lot more than 2% a year because they went up by that much. Okay, prices have gone up by 6% to 8% over the past few years. Why can't they go down by the same amount? Okay, I think that if prices went down that much, people would be very happy and pleased. But no, that's not even an option, because the Fed doesn't care how much prices rise, they have to keep going up. Okay, the Fed wants to make sure that prices go up another 2% the following year. If prices rise by 50% in the previous year, that means you're at 52% and then 54%. Okay, it's not possible for prices to go up 50% and then down 10%. That would be terrible, I'm afraid. That's not okay. This is exactly what Powell says. That's why this 2.5 to 3% inflation isn't that. You need to think about it in light of all the growth that came before it. Prices do need to go down. To get prices back down, we need interest rates to go up a lot. Powell wants what he said would take a while. Prices need to go up to match pay, okay? And that way people could pay. To put it another way, he wants more inflation so that people can get higher wages that will allow them to pay for the higher prices that came about because of the last inflation. But of course, the measures he is pushing to raise wages will also make prices go up. It will be like a dog chasing his own tail. It won't happen ever. Powell actually said that they want to lower interest rates because he said, we're in a good place, but we're in a challenging place. The good news is that the economy is growing, we got full-time jobs. But he said that the risk is that inflation will go up and jobs will go down. So we're in a tough spot because we need to raise rates to fight inflation, we need to lower interest rates if we want to fight unemployment. It's clear that we can't do both at the same time. We could pick one. We're in a tough spot because we don't know which way to go. Okay, he did say that they are able to boost employment by lowering interest rates though. He said that this is because lower interest rates increase demand, and when demand rises, jobs are created. That's not true either. That may be what the Federal Reserve thinks, but increasing demand alone doesn't create jobs. In fact, lowering interest rates only makes it cheaper to borrow money and buy things, which means that supply is actually slowed down by these rate cuts. This is because lower rates encourage more consumption, but only to the extent that you borrow the money. The economy doesn't grow when people borrow money and spend it. Prices do go up because of it. Okay, this means that when the Fed makes it easy for people to borrow money and buy things, prices go up. Making things, on the other hand, is what really grows the economy and creates real jobs. And by falsely lowering interest rates, the Fed actually makes people less likely to make things. We need interest rates to go up so that people can save more money and use it to fund more output and capital investments. We make more stuff because of this, and in the end, it's the supply that makes real desire. That's where we can find good work. Giving more credit doesn't help us get good jobs. Okay, the Fed wants to do that, which is to give out more credit. That will in fact cause inflation. I've already said that inflation is more than just more money in circulation, it means that there is more cash available. The feeling of being in charge is quickly disappearing. Cutting interest rates by the Federal Reserve is no longer a way to keep things stable. Those things have turned into desperate acts. Every effort to boost demand makes inflation worse, which hurts savings, lowers real pay, and punishes people who don't spend more than they earn. It is getting harder and harder for Americans to believe in policy and the dollar itself because of this loop of lying and manipulating. The basis of sound money keeps falling apart because the Fed cares more about how things look in the short term than how they work in the long term. Cheap loans or fake demand won't help the economy get better. It will come from being honest, taking responsibility, and getting back to real value. It's not too late to act after a disaster, before it explodes.